All right, so after such an extreme bout of selling last Wednesday, we rallied into the close, and then tapered that off today with an inside day. So now the question is, was that rally into the end of the week? Was that the beginnings of a good bullish bounce? Is the correction over with, or was it just a snapback oversold bounce? And then today's candle confirms that that's all that it was. So we're going to break that down from a technical perspective. We're going to look at these different indicators to see whether or not we can expect now to rally for a little bit here, following through on what happened Thursday and Friday of last week, or if we've seen patterns like that where we've had the break, we get the snapback, and then the snapback peters out, and we roll back into what the break started us on. So we're going to take a look at some examples there and see what we should expect to see. And we're also going to look at a trade in a stock that's kind of had both a big rally and a big snap back down, and how that sets us up for a pretty popular trade that we've been doing a lot of lately. So let's go ahead and get started. Today is Monday, May the 17th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator, as we always do. And you can see today we had an inside day. So today's trading range sitting completely inside of Friday's candle. After Friday got back up above a rising moving average, we stayed above it today, flirting with it a little bit, but it finished above the moving average. But that didn't stop the intermediate line from dropping, and is close to dropping below 60. Right, to where it's not bullish anymore, right? Doesn't mean it's bearish. It doesn't really get to bearish territory until you drop below 40, right? Because see, that's where the Russell is. The Russell is at below 40. That's a bearish, even though it's rising, you're in bearish territories. That's why it's so weakly bullish. But that is a pretty strong short-term sentiment. Near-term line really jumping up there pretty hard. And if you take a look at the NASDAQ, actually, let's look at the NASDAQ composite here, and you can see it is also below 40. All right, with this near-term line up above, just a smidgen up above 80. And the momentum line for all of these all dropping down. You can see dark pink shading and a red line now with the moving average now rolling over on the NASDAQ. So a little bit of a Harami pattern. So that's the ramifications if you get below 40. But you can see with the S&P, because it's been so much more linked, that you can see the Dow actually has broken below 60 pretty significantly. So you'd expect that the S&P will too. It's going to depend on where this near-term line peaks. As of right now, if this is where it peaks with Friday's high, which is kind of what we talked about. We talked about last week that we'd get a rally into the end of the week, and then more of a selling or more weakness going into this week. I would expect that near-term line to peak here. I don't think we'll go that much higher on a near-term basis. Would be a lower near-term high point, and obviously would set us up for a lower near-term low point at some point in time once it's all said and done. So that's how the market forecast. So a weak bearish posture, light pink shading, and again it's going to get more bearish because we won't be above 60 anymore. Right, when you're above 60, you can see over here. Now remember, on the S&P 500 or NASDAQ, we actually did drop and actually did get an intermediate pullback here. And over here, we just dipped our toe below 60 for like 2 days. But one day there on the bounce back up, we had finally dipped a toe below 50. On the next day, on the subsequent even more bullish day, we only went down a couple of points to the intermediate line to the 57th percentile. And then we were right back above 60 on that third day right there when we bounced back up. So just like that, right? That's as much as we dipped below 60, and then there a little bit more. But like I said, that was an intermediate pullback. You go to some of these, obviously that was an intermediate pullback, and you can see over here again we dipped our toe below 60. If we finally drop below 60 on the second day of rallying off of that light pink shading yellow line. And then, another day staying below it, a couple days there, and then finally getting back above 60 on the breakout. So again, kind of looking like here, this very similar type pattern where, a couple of days after the light pink shading and the yellow line, we might finally dip our toe below 50. The difference is on some of these other charts, for example, back in June and back here in February, if I look at the NASDAQ 100, in February, so right there, same level, we didn't even come close to 60 on the NASDAQ. Back in June over here, we didn't come close to 60 on the NASDAQ. So, you know, this move on the S&P wasn't quite confirmed. These moves wasn't quite confirmed on what we saw on the NASDAQ. The NASDAQ was a lot more bullish than the NASDAQ 100, which, remember, you know, makes up a huge chunk from a market cap weighted standpoint, makes up a big weighting of what's in the S&P. This go around, it's a little different. We actually are worse this time than we are in the S&P. We're not only below 60 already, but we are also below 40, which suggests that that's the path that we're most likely going to be headed towards on the S&P, and then eventually the Russell 2000, you know, which is also below 40. And over here we also dipped. That was the Russell's period of weakness there. But back here in February, you notice we didn't get below 60 like the S&P did. So you can see how some of these other indexes, the Russell and the NASDAQ in particular, which lately haven't been moving together very well. They've been kind of passing the baton to each other in terms of who's going to lead who. Now they're both showing more bearish patterns than what you're seeing on the S&P 500, the broader market as a whole. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Ring that bell as well. That will help with those notifications. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, and that you want us to do another video again tomorrow. It's a quick way to give us feedback. It really helps us out because it promotes our video more. It also helps you out too, and it helps us see, you know, whether or not, you know, we should continue doing these videos based on the response that we get from them. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you want to let us know that you like them, that you like us to keep doing them day by day, just the one click you can even do right now while you're watching goes a long way for us. We really appreciate that. Also, comment down there. What did you get out of our video today? What stood out to you? Why should other people watch it who are coming for the first time? Post any thoughts or comments or questions you have in the comment section below. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link and go subscribe to our site for free. You get access to our Market Outlook community on our website, so you can be able to interact with other viewers, other market scholars who watch these videos day by day. Also, follow me on Twitter for more content in between the videos from David. It's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things over here on the right, including our Market Outlook live videos. Every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time. I review all the trades we've been doing in these videos to see whether or not we should stay in them or close them. So we talk about, that's a very, very important part of the process, obviously, because anybody can tell you what trade to buy, but not a lot of people will continue to follow up on that same trade to see whether or not it does what you expect or not, and then how to manage it accordingly. So that's what we do in these videos. So this is probably even more important from an educational standpoint than what we talk about here, to continue the process all the way through. We also have our trading rooms. These are just kind of a small sample of what we do in our trading rooms. There's our schedule over here on the right. Again, all of our paid subscribers get access to all those videos. Of course, our premium subscribers get access to it on a cheaper basis per month. As in addition to that, our premium subscribers get access to our premium tools and resources, as well as access to our class forums. So there's a benefit. And you can see, if I click on the word pricing, you can see the difference between the two. Come down here, click on this heart. It opens up a new tab. Click on this like button right there. Also click on this thumbs up, opens up another new tab. I invite you to click on that like button too. Again, the more you do that, the more people you'll see our content, because the more engagements these posts have, the more Facebook will promote it to people who actually do follow me, based on when they're looking at their platforms. Also, it benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at the weekly chart, and you can see the bearish candle here forming, the transition candle we had last week, and pretty much a pretty small candle this week. Last week we had the NDX give us a bearish candle, so far giving us a bearish candle as well. This week, same thing with the Russell. Very small bodies though. Now keep in mind, if you look at the actual candle for the S&P 500, that we ended up with a pretty decently long lower shadow there. Now those aren't as bearish as long upper shadows are. We just don't tend to get very long upper shadows, generally speaking, because the volatility ends up being so low. So for us to get a long lower shadow can be relatively bearish when we've had a bullish move like this. It kind of shows us that the bears are around, right? They're in the vicinity, right? They weren't in the vicinity during any of these weeks. Very small moves, very low shadows, lower shadows. But now we got a pretty decently sized lower shadow, which means now the bears are in the vicinity. Obviously, you know, the bulls ended up with the upper hand by the end of the week, which is what matters the most. That's why it's not as bearish. But the fact that they're in the vicinity is something to keep an eye on, as we saw so far, just to a small degree here today. If you take a look at the 3 green arrow chart, you can see, here, let's go to the 3 green arrow chart actually. You can see we have 1 green arrow, so the stochastics turned up slightly, or actually we have 2. The moving average, we're still slightly above the moving average. Again, if you look at the 2-line versions of that, you can see we are still below the moving averages. So we got a rise in the MACD, we got a rise in the stochastics, but they're still below the moving averages. So until we cross through those moving averages, these aren't bullish enough to be considered bounces until we get through, because again, we're so far extended away. It's hard to extend too far away without, you know, even some short-term jumps back to the moving averages before you continue to the downside. That's why I believe that we're getting here right now. If you take a look at some of these other indicators like the RSI and the CCI, we did get back above 50. So just a brief churn below 50 here. Of course, when you get below 50 and stay below 50 is when you're more bearish. All right, so when you look at some of these other intermediate runs over the past so many years, you can see you get below 50 and you stay below 50, right? You get below 50 and stay below 50. You get below 50, stay below 50. You know, that's a pretty good, decent hallmark of these other intermediate runs or pullbacks that we have. So far, that's not necessarily the case. You know, and again, on the you can see on the S&P, you know, we were up and down, up and down, up and down. But for the NASDAQ, if you notice, we did get below 50 and stay below 50 for a while there. So you can see how these intermediate pullbacks work here. And we got back above 50 yesterday. Was unable to get back above 60, however, which is the bullish territory. So we'll see how that ends up playing out. We did drop below negative 200. And we made a little bit of a, you know, again, that directional move that we've talked about, where not only does the positive drop below 25 with the negative already above 20, ending that bullish run, but we also got to break up above 30 at the same time that we jump below 20, so a little bit of a bearish breakout move there too. So now, you know, we drop back down below 30, still above 25. We did jump up above 20, but again, with the negative still above 25, it sets you up for another leg lower. This isn't necessarily a back to a bullish crossover yet, so definitely something to keep an eye on. If you look at the Qs, you can see not nearly, I mean, we are still below 20. We are still above 25, so easily still bearish there despite the pullback. And the same thing here, still easily above 25, still easily below 20, and have been for a while. So this goes to show that we are in more of a directional move to the downside. And remember, the S&P had ended its strong bullish run. The Qs obviously looks a lot more bullish, right? Being below the blue lines for both, you know, respectively, being below their blue lines for a more extended period of time. The S&P got below and bounced back above, but the others got below and stayed below for an extended period. So again, they are kind of showing the type of pattern that we can expect to see here. You can see the red line still just barely above price, but again, looking at the alternatives, the red line is below the price now, which is bearish on the Qs, and the red line is below the price as well on the Russell 2000. So it goes to show again that these other indexes are showing the bearish patterns that they may be leading the S&P towards here once we get more of a broader exhale than what we've seen in the last so many months. All right, now let's take a look at the intraday chart here. And so you can see how, we're kind of in the middle of the range, but you can also see why we're kind of stuck here, why we couldn't keep going higher. As we saw on Friday, we hit that resistance, but you also see that we're building up a pretty decently sized volume space here in the very, very small area. We have not started to fill in the gap from Friday, which is still I consider it a common gap. So that's why I think, tomorrow, and if we do fill in that gap, which remember starts way down here is where that gap starts, because that's where we close that day. If we're going to fill that in, that means we're going to be breaking through the bottom again. Hence why I believe we're going to be a lot more bearish here this week. Remains to be seen, of course. The resistance, the IWM is sitting at its resistance. Also got up to Friday's high. Again, still has a gap to fill. And of course, if we fill in that gap, we'll be breaking a pretty decent volume node there as well, setting us up for a new 4-week low point. And then again, of course, the Qs gap down today and did not fill in any of that gap, and still hasn't filled in. Still didn't get quite into the gap from Friday either. So all of them still have, and they all have bearish Arun indicators here. As you can see here, let me get rid of the volume over there on the chart. So you can see how we're still pretty bearish. Again, that's actually a sign of a bearish pullback on the Qs. Which remember, we actually are in already. I mean, we're starting a new one on the Qs. You can also see here on the IWM. Again, we got up to 100. We're well up above. And of course, looking at SPY, we just barely got above, and the positive is still up there. So you can see they're kind of both moving, but it looks like we're in the situation where we might start down before popping back up as the green line continues to come down. That type of pattern, which also again started that interim. So very, very, very typical patterns on this particular indicator that usually start the beginnings of intermediate declines. Let's take a look at today's intraday chart. Let's see right here. Oh, so excuse me, the volume today, sorry, is what I wanted to take a look at. You can see we dropped considerably lower to 65 million. The range got considerably smaller too, to only 3 points. So when you look at that in perspective, 3 points is way back down here after some pretty big ranges previously. The volume is 65 million down here too, so that kind of rolls us over. Just barely being above the 1% mark kind of rolls us back over. So we'll see how much that plays out, in the next couple of days. If we continue to grind, or and more, I expect we'll be back to bigger volumes and bigger ranges. It doesn't have to be extreme. If they get extremes, then it'll be like a 1-day sell-off, and that's it. But if it's, if we end up getting about 85 to 100 million shares with a 6 to 7 point range, maybe about 7.5. in that area, those are bearish levels, because that would bring these up, but not extreme bearish to where we'd pop back up immediately like we saw on Wednesday, that we talked about last Wednesday's video, where we had such extreme numbers that it was most likely we were going to bounce right back up, and we did, right? So now I think we'll start to get more gradual, bigger, but not extremely bigger, so that they can be more gradual, and we'll pick back up with some bigger moves after a 1-day respite today with a small range and small volume, and for that matter also a small move when you look at this chart. Right here we go. You can see, again, you get a big down move, you get some up moves, and now we'll see if we transition to a bigger down move again, right after a small down move here. So you can kind of see you tend to get big down moves, bigger up moves, and then you can see small ranges, small down moves that would then reverse themselves into bigger. So that's something we want to keep an eye on going into the rest of this week here. Let's take a look at the RSI and the CCI. Again, you can see some of these levels. Excuse me. Sorry, I'm on the wrong section. The VIX is where I wanted to go next. If we take a look at the VIX, you can see, again, pretty, we bounced back up. We came down, but we bounced back up. I think this is kind of our low point for this current decline on volatility at the 85% mark. I wouldn't be surprised now if we don't start making our way back up to the 100, towards the 100% mark, towards the higher 20s, maybe into the mid 30s. If that's how far we got here into the high 20s without getting to 100%, then that means there's a pretty good chance that we will make it easily into the 30s, if not to the high 30s, by the time we actually do hit the beginnings of the intermediate declines, which start typically with volatility heading up to 105%. I was talking to Gavin McMaster the other day in one of his webinars, and he talks about intermediate pullbacks, corrections don't start until you're above 100% on the VIX, relative to the VXV. And obviously that hasn't been the case yet, which means we haven't had a correction yet. And that's something we've talked about too, with that zigzag indicator. We just haven't had, more than here, let's switch this to a 5% decline. Here we go. I'll switch this to a 5% decline here. But you can see, we haven't had enough of a pullback to be considered anything more than, as of right now, it's just, I think we got to 4%, but that's not enough. We didn't even get a 5% pullback in any of these areas, whereas we did there in June temporarily, and then of course these two times when we actually did get a pullback in September, and then again at the end of October. So to summarize the technical outlook, we kind of got a break last week. Obviously didn't start, but it was kind of the crack started to form in the markets last Wednesday in particular. But it was so extreme in such a short amount of time that it led to a quick, just very short-term bounce. And we saw that going into the end of the week. And now today, very small range, kind of showing that this bounce was just an oversold bounce and nothing more, not a bullish bounce in terms of getting back on the trend. So it looks like our expectation is still of kind of leading into more weakness this week is still in play. Now, of course, things can change, and if we end up breaking out tomorrow to the upside, then things will change. But as of right now, my expectations based on how things have been playing out here, and based on those breaks that we saw that we've talked about last week. My expectations are that it will most likely lead to eventually this exhale that we've been anticipating. Again, because of those breaks. So, and we're again today it was still very small range, very small volume. After a bounce, kind of suggests that that might have been it. That might have been it for the bounce. So what do you think? Do you agree with that technical assessment? Do you disagree? What do you think? Let me know in the comment section, especially if you disagree. What charts or comments or indicators, are you looking at that suggest why you're a lot more bullish than I am, or maybe you're a lot more bearish than I expect to be? That's going to be more than just an exhale here. That we're actually going to get a sick market, like we've talked about before. So, what do you think? Share in the comment section below if you disagree with what we just came up with here. All right, now let's take a look at what's driving the price action today. You can see a very minimal day today. Of course, stocks were down for most of the day. The Q's down more than anything, but everything rallying by the end. The Q's still down about 0.5%, but everything else was really, really small moves. On the other side of the table, though, you can see a 1% plus moves in gold and commodities. So very anti-dollar trade as the dollar was down most of the day. You can also see bonds were down most of the day. Of course, that's inflationary trade. Whenever you see a lot of these commodities and bond yields and gold all rallying with a falling dollar. If you take a look at the market forecast for the dollar, you can see it's still kind of flirting with this important 23% retracement level. We anticipate in the long term a bearish move on the dollar, but again it'll be interesting to see if equities will have or can have an exhale if the dollar breaks back above this level, because breaking it back above 23% means here we go again, new bullish trend, new bullish run. We got the beginnings of here, but we're still stuck below an important ceiling that we really haven't been able to get through. If you notice like how the dollar has performed against other currencies like the Canadian dollar, look how bearish it is there. So there's definitely some bearishness going on in the U.S. dollar. Compare it to the Australian dollar, and you can see after a good run up, it's been pretty flat. And of course, the pound U.S. dollar, you take a look at that one too. Very same concept, right? Trying to get through the resistance that we established back over here with these overbought clusters and that long upper shadow reversal pattern. So it's trying to get going, and it's not quite able to really break out necessarily to the upside yet. So, of course, that's also going to have an impact on like gold. If you take a look at GLD, you can see the breakout that it's really taken off to the upside. TNX bond yields are trying to get going again too. Again, very inflationary commodities. You can see the bullishness that they're on. Again, this would not be risk off, mind you. They would be. These are all very inflationary trades, not necessarily deflationary trades, which is what happens when markets do get into kind of a risk off mode. And as we saw again with QQQ, they're the ones that are kind of suffering the most from the risk off pattern, as we saw on the intraday chart, already showing a bearish market forecast, more bearish than what we see in other places. And of course, we've also talked about the Russell having the very top heavy move and a very quick move over here that gives it a very poor margin of safety in any kind of decline. Of course, you'd have to break through this horizontal level here before you really start worrying about the beginnings of one, but the patterns are there, right? The patterns are there for that exhale to begin. Well, if you look at the ratio charts that we've been kind of watching ourselves pretty closely here to see how they've been performing, you can see from a sector rotation standpoint in terms of whether or not we're done. Here's the daily rotations, with the longer term rotation showing pretty clear risk off patterns, right? Utility, staples, healthcare, real estate, with financials, communication services, industrials, materials, all kind of starting their rollovers. But again, as we mentioned, we're still in one last rotation to the upside in these sectors here on a daily basis. Still that one last up to the right, and it looks like they're starting to lose some of the momentum. Industrials doesn't have doesn't have the increasing momentum anymore. Financials is losing its momentum. Materials, the momentum appears to be peaking. Energy has been losing momentum. So they're still gaining relative strength, but they're gaining it at a falling momentum rate, which I expect the next time they move down to the left with falling, with weakening relative strength, will be that will be the time that we actually do get. And this again bounces back up above its 30-day moving average. That will be the time where the pullback will actually be beginning. And you can see we're not quite there yet. When you look at the current run these sectors are on, you can see the strength in these areas like energy, materials, and financials and industrials. Again, let's just look at today alone and see how they did. And you can see the big move higher in these kind of risk dollar sensitive areas, inflationary type areas, energy and materials really ramping up to the upside. Whereas in the other end of the spectrum, for most of the day, technology, discretionary communication services, your QQQ type names, really lagging behind, with utilities kind of falling off at the end. So again, there's gonna, when we actually are in risk off mode, it will be not led lower by these three because they've already had their decline, right? If you look, over the past, I don't know, few weeks or a couple since the beginning of April here, you can see they've already been lagging behind. They've already had more. These areas, financial, materials, energy, they have a lot more to lose, as you can see by the gap between them and these other sectors. So once they start to underperform, that's when you'll see that we actually are in pullback mode that we've been flirting with even more, really flirting over this past so many days. If you look at the 12 grid, and I've shown you before, when does a correction start, right? Well, it doesn't start with patterns that look like this. You can see technology, discretionary communication services are moving in that direction, but dark green shading in a red line is not patterned for corrections, right? And here we're in light pink shading, but still a green line, and all the rest of these, right? It's dark pink shadings and red lines, and when we're in correction mode, they all move down together, just some more than others. So again, these two have already started that move. There's a lot more to run to the downside in some of these other areas. So they are going to be the ones that end up dropping the most once we are actually, again, in pullback mode. All right, so for our trade idea of the day, I wanted to take a look at Pulte Homes, which has been a pretty decent move. In fact, this has been a trade that we did a bull put spread on for May expiration that's still holding up pretty well, actually. despite the decline in the past week. Looks like we're more likely going to get what we want out of that trade. But now, with the decline off of such a strong high point and a pretty decent support level down below too, when you look, at like the Bollinger Bands, you can see, there's a pretty decent, I think that's where the value area is. Yeah, that's where the value area is, and there's a pretty decent volume node support level at the top of that value area. So the market forecast pattern is not showing it's not showing bullish anymore, but not bearish either, right? We're not above 60, we're down below 50. You can see that confirmed in some other oscillators. We're not bullish anymore on Pulte Homes, but we're not really excuse me. How about I actually type in the right symbol? We're not bearish either. We're not below 40. We're not below negative 100. If you look at the directional movement index, again, we're not bullish anymore because we're down below 25 on the positive and well above 20 on the negative. But we're not bearish either because we haven't dropped below 20 on the positive with this rally higher on the negative. So that sets us up for the types of trades that we like to do, right? We like to look for stocks that are kind of trending sideways. So we come over here to our trade tab and we say, okay, let's take a look at Pulte Homes and select our strike prices. You can remember we already did this trade in our Market Outlook Live earlier today, but we can sell that 30 delta, sell the 39 delta on this side, buy a strike away, so $5 away on either side for protection. That gives us our credit there in the middle, and it depends upon where we end up getting filled in at. I believe we got filled in. Let me take off of the trade. Here, let me get rid of that one. And we'll take off the trade from that's going to expire in May. And you can see, okay, so we got a full regular position size going for $600. I think we ended up getting, 3 contracts, so about 200, just over $2 per share, as long as we stay in that range. Again, that's kind of bracketed by the previous high in that bearish candlestick reversal pattern acting as a resistance, and the value area and that volume node acting as support. And with the volume or earnings behind us and the bandwidth relatively high and starting to move lower, as we see in some of these other times, that's usually when we just start to grind. We start to grind, and that's kind of what I expect we'll do here, is we'll grind into that June expiration within this channel. And if we don't, of course, we'll take, how much am I willing to lose? Well, out of that, since I'm trying to get 600, I'm willing to lose 600 out of that $900. So we can get out early if it doesn't work out. And we can even get out even earlier than that if we felt like it's really time to break out in one way or the other without having to wait to get to an actual $600 loss. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there. Everybody's got access to it, even our free subscribers. So open up any new threads with any questions or comments you have about anything we talked about in the video today. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook too, and comment on our video. Have a great rest of your Monday night, everybody, and we'll see you all next time.